Technical look at the markets now. Ron William is with us today, technical strategist, MIG Bank, and joins us to run through what's going on with gold. And you've brought 4 different charts to help us understand what's going on with gold, Ron. The first one we have here, it describes some gold key trigger levels. Tell us what you see.
Yeah, well, basically we had a key momentum indicator, namely a DeMark indicator, signaling the drop, which led to a $200 drop in 3 days. And the key levels to keep in mind is 1600 on the downside, which would confirm a much larger decline, which we'll see on the next chart. If the market holds above 1600, then it would suggest maybe a sideways move that may continue higher. And on the upside, we would need to see a move above 1735 and then perhaps into 2000 thereafter. Keep in mind, one of the fundamental drivers to the drop is the actual CME hike in margins, which is up about 55%, adding further weight to the gold drop, similar to silver back in April.
Let's move on to that second chart that you mentioned a moment ago. This chart looks at some of the long-term gold cycles. What does this help us to understand?
Well, I mean, the big picture always adds perspective, and then this is a long-term log chart going back to 1999, so it's showing percentage movements on gold. And during that time, there are key cycle turning points on gold every year or so. What it does show is that, of course, we're in that risk zone at the moment, and we have been for some time, going into September as well. The second point is that I've looked at just as a basic analysis of the biggest corrections within that time period, 1999, 2006, and 2008. And the average drawdown to gold or downside risk is around 28%. So this is something just to keep in mind as kind of a potential risk scenario to gold if it were to break below 1600, back into the 200 moving average, and potentially a 25–28% drop. And the cycle studies actually suggest that.
Yeah, still sticking with gold for your third chart as well. Looking at the 2 years of sizable long gold positions under threat. Explain this one to us.
Well, this is very key, and I recommend this to everyone that looks at all markets, but especially gold. It's really important to keep an eye on the liquidity numbers. I mean, i.e., where is the money? Where's the money flow? Where's the actual commitment in the market? And this is just basically showing you the net long positions in the market, so the large speculator positions in the market. And it shows you that it's basically made a high about a year or so ago, and is now actually within a range. And if we were to break that key level that's just highlighted on the chart, that would unlock about 2 years worth of sizable long gold positions. It's something to keep an eye on. It hasn't broken yet, but if it were to, that would be a major unwinding of long positions on gold. And so for all the macro reasons as to why gold will continue this year or next year higher, keep in mind that this is an unwinding of extreme long positioning. This is a momentum unwinding on gold.
I believe that's also what your final chart helps us to understand as well. If we can just call up the fourth chart that you've brought to our attention today, talking about the potential for a major decline. I mean, that looks like a pretty steep decline to me. How does this play out?
Well, I mean, the other important thing is how does this impact all the other key markets that we look at? Where's the next safe haven? Where's the next flight to safety? And in my opinion, US dollar will be the surprise market, which actually appreciates in value potentially up to 30% over the next 6 months to 12 months. And gold's potential big decline, if it happens now or over the next few weeks or months, will actually, in my opinion, lead to a potential appreciation in the US dollar. Also, if it's coupled with a global unwinding of risk appetite and general unwinding of commodities as well. So far, we've seen Swiss franc unwind sizably, about 10% from its major highs, then switching back into gold. And if gold does decline, along with various other risk, coupled with risk markets, we could see a US dollar surprise and move much higher over the next 6 months plus.
Okay, Ron, thanks very much for that. Ron William, technical strategist at MIG Bank.